Hello, everyone, and welcome back to a show of the Integrating Investor. I'm Seth Levine, as you all know, of the Integrating website, Integrator Investor website, right up there. It's been a while since I've done a show alone. I almost forgot how, but luckily did not. I hope you've enjoyed the past couple interviews. Um, I thought they were pretty interesting. Again, my whole goal of these interviews is to really flesh out kind of investment frameworks, not really trade ideas, but really just into the get an understanding of how people think about investing and the frameworks that they use. Because just like everyone needs a philosophy in life, you don't have a choice, as Ayn Rand astutely noted and changed my life with that sentence. Everyone has an investment framework that they use, an investment philosophy, and we use it whether we know it or not. So, I've been on a journey of just trying to figure out my own, and I've done that by studying others. And these interviews, I think they've certainly been interesting to me, and I hope you like them too. Curious to hear any feedback that you may have. Leave a either drop me a note up there at any of the at any of those places, or leave a message in the comments section, not the chat, because the chat will kind of fly by. But if you leave it in the comments, I'll definitely check it out. I'm also pretty excited because I recorded another interview just a couple of days ago with Daniel Want. Daniel Want is a chief investment officer and co-founder of Prerequisite Capital Management. That is an Australian firm. Daniel is one of my favorite thinkers. I know I say this a lot, but that's the beauty of kind of hosting my show, is that I can reach out to the people who have influenced me the most. And Daniel is definitely kind of at the top of that list. We got into all sorts of kind of abstract thinking processes that I think is really interesting and just great for this kind of forum overall. And again, you won't hear these type of interviews really anywhere else. At least I haven't, and that's why I kind of started this. And hopefully that's not for a reason. Hopefully people do find it interesting, and it is it's not just me alone, but I guess we'll find out. So back into this show. I'm kind of excited. This was one of the first. These topics were really the conception of how I came up with the show itself. Aside from just the investment framework angle, I really want to get into some of my unique views on money, banking, and central banking, because I think they're very, very different. I don't know if that's right. I hope it's right. But it's really, I've spent a lot of time thinking about these issues, and I come to really different conclusions than really most people out there. This isn't also, so I'm going to go through I'm going to go through these views probably in a couple shows. I think it's going to at least be 3 parts, but we'll kind of just see. Maybe it'll be more, maybe it'll be less. We'll just kind of take it as it goes. And I really don't want it to be a lecture, even though it may turn out to be a lecture. So I really love feedback, kind of know like what everyone thinks, because it is pretty different. And as always, please, like and share the show. It helps me a lot, really help me get the word out, especially on these topics. I'd love just to get as much feedback as possible, because they are going to be different. You can follow me on Twitter, Instagram. I don't really do much on Instagram again, but Twitter is a great place to find me. It's the website. Sign up for the month for the email subscription there, and you just get my monthly articles sent directly into your inbox. Please use the super chat function. As try and use the chat. I'll try and check that out as well. And again, if you have any show topics or interview guest suggestions that you'd like me to interview, you could reach out at any of the forums up there. Contact form on my show, or email me at info@integratinginvestor.com. Just info at the website, the website up there. So right off the bat, MA, great to see you again. Thank you so much for your generous donation. Always appreciate it. Hopefully you find this topic interesting. It's going to get a little bit dense, but hopefully we'll be able to kind of keep it on the surface level enough. And if you have questions, please feel free to throw it in the chat. Hopefully I see it. If not, I definitely will see the super chat. So moving along, as is the most fun thing that I do here, we will start with the disclaimer. Again, these are just personal opinions, not investment advice, recommendations to buy or sell anything. Do your own work. there's no investment advice coming here. So moving right along. So what I'd like to do is present my kind of unique view on money, banking, and really central banking, because that is kind of where it all leads to in the end. Because banking, again, central banking really is just banking in a different form, hence the name banking in the name. And I'm going to draw from a number of articles that I wrote in 2019. And I linked them in the show description. I think, at least I hope I did. If not, I'll put them there. But there's a few articles. There's kind of a 3-part series called Powell's Real Choice: His Reputation or His Esteem, as in Jerome Powell, the Fed president, FMOC president, I guess, governor, or whatever the title is. Central banks don't create money, really. I did that in February of 2019. The first article was in January 2019. And then cheap Fed liquidity forestalls deleveraging and entices debt, right? A mouthful right there. And that was in March of 2019. So those articles were a bit of a kind of how I started the ball rolling down here. And I put it all together in a report I did for a friend's subscription. Part of a compendium of reports is called "To Fight the Fed or Not," and you could find a link of that from April 2019, right? It's where I kind of put all these thoughts together, where I was kind of writing in a blog, and I kind of made it a singular piece with better flow into "Fight the Fed or Not." And what's interesting about this exercise, at least for me personally, is my thinking really evolved as I started to write this, right? So if you look at the first piece, is called Powell's Real Choice: His Reputation or His Esteem, part 1, right? There was no part 2, right? I actually kind of abandoned my view after writing that article, and kind of as I was getting into trying to write a part 2, I realized as I was researching the topic more that, I had just had this I was kind of taking on a completely different path, that I had to revise that kind of prior view. Where I kind of started with this Austrian economic view of the world, which I think maybe many do. And I think there's a lot of great stuff there for sure. But then I was reading some other works, and specifically kind of Hyman Minsky. And he's a new Keynesian, right? But he, to me, had this real interesting understanding, I think a really interesting understanding and kind of expert understanding of banking that, maybe some of the Austrians maybe lacked. So I took some of Minsky's views, and I started to integrate it into that Austrian framework. And, I even took some MMT stuff from Randall Wray. He is Randy Wray is one of the MMT founders. And there was a paper he wrote specifically, I think in 1992. I think it was 92, maybe 96. Anyway, that's in the second article, Central Banks Don't Create Money, Really. I linked to it in there. And, I took some of his work on a historical basis and kind of put it all together. And it's not that I think MMT is right. I mean, I think it's quite wrong. I don't think New Keynesianism is right. I think it's quite wrong. But there were elements of truth there that I was able to integrate into that base layer of Austrian framework and kind of come up with a new kind of thinking about all this. So, I'm not sure how common this integration, at least that I've made, is. I don't know how right it is. Again, I'm just presenting it and hoping to solicit some feedback. What I found is that each school had some valuable and true insights that really helped me paint a better picture, and specifically of the financial system, right? I was looking specifically into the financial system and how central banking impacts the financial system. And really, I was taking that too. And also, don't forget, well, I shouldn't say don't forget, but, I've been a professional investor. I was at one of the big money center banks on the trading desk as everything was blowing up kind of in the great financial crisis. And I was seeing things there that didn't make sense to me before the financial crisis, but then started to make sense to me as I integrated all of these thinking, all these other kind of theories and observations in. And so again, I'll get down to that. So I think I have some pretty unique perspectives that's not really shared by anyone else. So I hope this helps you. I hope it helps me. I hope we kind of can get a discussion going. I'm really going to center on, thoughts of like, what is money, right? Why central banks don't create money, and what does the Fed actually do, and how does it really impact the economy? Now, these are, of course, working hypotheses. It involves some philosophy in it too. It involves some economics. I'm not an expert, really, a subject matter expert on really any of this. So if there's anyone out there who's interested in, in these topics and has a background in either philosophy and/or economics, please reach out to me because, I think we can do some research and maybe make this into a book if it makes sense. So again, not a project I can tackle myself. Really need some subject matter expertise. I know there must be some of you out there. Reach on out to me, any of the above ways, and who knows, maybe we'll have a book on this. So, all right, MA. Oh, thanks a lot, MA. Again, MA asks, how would one fight the Fed? How would one fight the Fed? How would one fight the Fed? Well, in that article, there is what I mean by fight the Fed is really there's an investing expression, don't fight the Fed. And what does don't fight the Fed means? What does that mean? It means from an investor perspective, invest along with what the Fed is doing. So if the Fed is trying to, I'll just use some vague words here, inject liquidity or support markets in a period, you're supposed to just trade alongside the Fed. So if let's just say markets get weak and the Fed steps in, you're supposed to buy the markets go long, right? Because the Fed, supposedly has all this control over the markets and can make it go up and support the markets irrespective of everything else going on. So maybe in and of itself. So that's a big trading mantra. Now, there are instances where people fought the Fed and won, and the most notable one is George Soros. He famously broke the back of the Bank of England. So he bet against the Bank of England, expecting a currency depreciation that the bank wouldn't be able to support it, and made like billions of dollars on the trade. And yes, so there are no muskets. Yes, we are. This is friendly, voluntary fighting. It's investing. It is not muskets, AK-47s, or revolution of any sort. So let me set the context here, and I'm already slipping behind schedule. So I started really getting into this topic in 2013. For me, it was like the 100-year anniversary of the Federal Reserve. I was a guy on the desk. I had seen all sorts of, I took my professional experience and didn't really, to me, there were just too many contradictions with the theory of central banking and what the Fed does, and the markets and what I was seeing, and the my understanding of economics at the time. So I dove in, right? I read a bunch of stuff. Won't really get into it, but in 2013 in particular, there were a lot of articles coming out that were critical of the Fed and kind of looking back on the Fed's history, because it was the 100-year anniversary of the Fed. So reading all this stuff, and again, 2013 was after the great financial crisis. We had this massive amount, and it was unprecedented at the time. Unfortunately, I wish it hasn't continued, but it has. Massive, unprecedented amount of central banking intervention. The Fed had been Fed lowered interest rates to zero. In Europe, they had taken it to negative interest rates, right, which is kind of strange. And they've done QE, right, quantitative easing. They've just been buying back bonds in the market, just hand over fist. And as capitalists, I expected all this bad stuff to happen, right? I expected all this inflation to occur and all this, markets to bubble and crash over. But none of that really happened. And this had gone on, and had been, from then, at the time that I was kind of studying it all through 2013 up until 2018, right, when 2018 is noteworthy, and why this journey, the next leg of the journey starts here, is because the Fed started raising interest rates in 2018, and it started raising it. It started raising it in 2016, right? So there was almost 8 years of zero interest rates and negative elsewhere, and it started raising it very steadily in 25 basis points increments We had kind of liftoff, right? That was the market. We had a liftoff from zero and everything was kind of going smoothly, right? But then at the end of 2018, something happened, right? Stocks started to wobble, right? By wobble, it started to sell off, right? There was a period of time, there was a meeting where, there was a big sell off. And I was saying, okay, like why did that happen, right? Then we had in February this event called Volmageddon, right? Volatility, right? There was a lot of, I won't get into it right now, but volatility selling. It was kind of an esoteric trade that had really gained popularity. That really was a kind of in the spirit of don't fight the Fed. And there, again, there was a lot of prediction that the trade would go really wrong, and it actually did go wrong in February, right? And markets were soft, so there was that markets where there was a hit in February, or the stock market in particular, and it was soft through the spring. But then it picked up speed again until September hit, and in September of 2018, there was kind of a panic again about the Fed raising rates, right? Because there is this belief in the market that the Fed can control interest rates, and via its interest rate, it can control certain interest rates, but it controlled the stock market. So here's a picture. We're going to set the stage right here a little bit. I know I'm going a little wordy here, but we'll see. So this is kind of 2012, right? The blue line is the Fed funds rate, right? The upper target, it's zero for a long time. And then the Fed just very slowly started to raise interest rates. And what you can see is the stock market in red. This is the S&P 500. It was pretty good. Things were going up, and then it got a little soft heading into the interest rate hike, which many people expected, right? So this softness, people expected the Fed's impact. The Fed the interest rates have an impact on the stock market, and it was soft here. But then the Fed kept going, and the markets were looking great until right here. Right here, the beginning of 2018 is the Volmageddon event, right? Markets went down pretty significantly. This is a pretty sharp decline. We actually saw them circuit breakers were triggered, right? They halted trading because declines were so big. But then everything took off again until this period here, which is the period in which I started writing my narratives and kind of doing my deep dive. So that's the context, right? Markets had just sold off. Markets had just really sold off had sold off for a couple months. In September and December, the stock market was really hoping for the Fed to pause, right, and take note and support the stock market. But didn't. But the Fed didn't. They stayed the course, and there was a giant sell-off. Right. And this is the world when I really dove into the topics of furthermore into the Fed, money, and markets, right? And again, at this time, 2018, central bank intervention was still pretty novel, right? It had been kind of 10 years of intervention, but it's been the only 10 years where we had this kind of intervention. The economic growth at the time, 2018, was pretty meh, right? Like it was pretty just sideways, wasn't doing too much. The central banks kind of seemed trapped in this because there wasn't much growth, and they had intervened, and there was a lot of uncertainty as how much they could support growth. We had all these, the predictions about QE, right? QE had started in 2012. All the predictions about runaway inflation, stock market bubble concerns, they all kind of weren't coming true, right? There was no everything bubble pop as many expected throughout this time period. And again, there was just an explosion of volatility selling and ETFs, and just a furthermore of this financialization of markets, which, scared some people. So there was a lot of trepidation at the time. With me, I had a lot of trepidation, especially with bubbles and what would go on with volatility. Was there a bond bubble? Was there a stock bubble? What did this mean for volatility? All the volatility selling, right? But none of my expectations were really playing out, right? It just, all that fear just kind of, nothing bad happened, right? So nothing bad happened. I had a hypothesis. I mean, I had a choice, right? I had to face the facts. I didn't have to, but I did face the facts of, do I entrench myself in these views? And, maybe it's just another 10 years, right? Been kind of sitting 10 years waiting for something to happen and it didn't. Or do I re-examine, right? Do I re-examine the thesis and start trying to understand where I went wrong, if anywhere, and reevaluate? So that's what I did. I had a kind of background in exploring these topics kind of separately, but I really just started to kind of integrate them and put them all together. So that's kind of that's the context for this. Is pretty wordy. Just pause here, see if there's anyone in the chat here with any questions. MA Janet Yellen reminds me of Dolores Umbridge. Yes, I know she's not the head of the Fed any longer. Yeah, now she is the Treasury Secretary. So still involved, still very much kind of a part of the conversation. That is for sure. But yeah, okay. So let's just move right along. So my journey kind of into this macro world. I mean, this is the precursor to my blogging too. Like a lot of this work led to, and the reevaluation led to the blogs, right? I was interested in trying to untangle my view, right? Something did not make sense. The facts of reality were not supporting my hypotheses. So let's get down to the bottom of this. So, like I said, my journey started with central banking, and because it started with the central banks, I really had to get into banking more generally, right? Like, what was banking, right? And then we can move on to central banks. So I naturally started with the Austrian economists, right? Austrian economics that resonated with me. Specifically, I found von Mises to be great on this. And what I found about really all the Austrians, less so von Mises, but they have at least when I started, there was a very mixed view of banking. Was fractional reserve banking fraud or not? Was it good? Was it bad? Right? There's very strong views of banking in the Austrian view that I just don't think, some of the Austrian views I should say, that I just don't think is correct. So what I did think banking was, right, is very much in that framework, right? I thought that banks took in deposits and then they lent out kind of the excess, right? They took in deposits, and then whatever they didn't need, they would lend out, but they would keep the deposits on hand for the people who may need their money and in order to meet withdrawals, right? So in a sense, the banking purpose, right, the banking model was a warehouse, right? They were there to store your money as a primary purpose. And in order to cover the costs of it, they figured they could lend some out just to kind of cover the costs and maybe make a little bit of money on it. But lending was very much kind of a secondary, it's kind of a secondary purpose, right? And in a sense, wouldn't really be needed if depositors would pay for that service, right? So if I would pay the bank to store my money, then, well, maybe they wouldn't lend altogether. And what I found is this was just wrong. This sort of starting point just led me to a wrong, but I think very common view of fractional reserve banking, right? It's not that banks can lend out excess reserves to cover the costs. It's not that they lend out these excess deposits in order to eke out a profit, right? The fractional reserve banking, it's not there really, it's not really there to secure the deposits, right? And private banknote issuance, which occurred during kind of the free banking era, right? That wasn't just a convenience for customers, right? I thought that when you go back to the freer parts of banking, that the issuance of banknote, you would bring your gold, let's say, to the bank and deposit, and they would give you a banknote like that. I used to think, well, that is just more convenient to carry around banknotes and gold, right? And that's why that evolved. So because it was just more convenient for the customer. But really what I found is, no, that actually is not correct, right? That is actually a benefit that the bank is doing for its own business model. And what is its business model? Well, I started to look at banks as borrowers in order to lend money out, right? I looked at borrowing from depositors and lending that out as an investor as the primary function of banks, right? So the primary function of banks was not to safeguard your deposits. Rather, it was to lend out. And how it lent out is it borrowed money from depositors as a cheap source. So in other words, banking really is a carry trade, right? So a carry trade is an investing term that is very common. And what a carry trade is you exactly what banking is you will borrow money, usually from a prime brokerage, but you're borrowing money and investing it. So in other words, you are investing more money than you are putting into the trade. And the hope is that you have to pay your returns, your investment returns can cover the cost of your borrow, right? Your cost of carry is what they call it. And you earn the spread in the middle. So let's say I am an investor and I can borrow money from a MA. MA says, I will give you a loan, Seth, and I will give you a loan for $1 million, and I'm going to charge you 1% on that loan. I say, okay, great. I will take that loan. I will take your $1 million. I know I have to pay you 1%, but I'm going to take that $1 million and I'm going to go invest it in this super awesome a bond that I believe in, and that pays 5%. Let's say. So what I do is I borrow MA's money, and then I take the $1 million and I invest it in the bond. Now, looks like free money, right? I haven't put any money in. None of my money has come into the trade, right? But now I just take the 5% that I get from this awesome bond. I pay MA 1%, and then I keep the 4% of the $1 million, myself, right? That is just money, free money to me, because I didn't invest anything in it. All I have to do is manage it. Now that's called a carry trade, and that is very, very common in the financial industry. In fact, this is what banking is, right? If you think about what a bank is, you give them your deposit, your money. Now they used to pay you, deposit, right? Deposit rate. They would pay you that the rate, and the bank would go out and take that money and make loans, loans to small businesses, and depending on the bank, right? And they would earn way more than what they paid in what they paid you in the deposit. Now they would keep a chunk of it behind, since they would call reserves, and they would keep that to meet the liquidity needs, right? In case you came in and tried to get your money, tried to make a withdrawal, or even to cover losses or anything. But basically, what we can see is that banking is a carry trade, and a carry trade is really leverage, right? So banking is just leverage, right? Because what they are doing is they're actually loaning out more money than what they take in reserves, right? And this is typically going to be like 14 times or something like that. I may be off on my numbers, but it's going to be somewhere between, let's call it 7 to 14 times, kind of the amount of assets that a bank has to the amount of capital they actually keep. So this was a huge aha moment, and this really came from Minsky, or part of Minsky's work, and that kind of led me to think, well, if that's the case, then it's really private banks, and only private banks, that create money, right? It's not. There's this notion that central banks. There's two notions that I actually kind of don't believe. One of them is that central banks create money, right? We think of central banks running the printing press and creating money, like the Fed just printed all this money. Well, my view, I just don't think, and my definition of money, which is going to be different. So that's a big caveat here. My definition of money is going to be different, and I think more epistemologically kind of consistent. And I'll get into that in the next episode. But this, not only do the central banks don't print money, but they can't print money out of thin air like many people think. In fact, it's really the private banks, and only the private banks, that actually do create money, and they kind of do take it out of thin air or create it out of thin air, but it's really the result of this leverage, right? There's a notion that can actually, there's even a notion that private banks can create money out of thin air, but it's because of accounting, right? It's just some kind of like accounting aberration. But really, in my view, these private banks do create money out of thin air, but it's the result of the leverage that they provide to the real economy, right? They provide loans to the real economy. The real economy takes these in productive ways. Now let's generalize and say they're productive. That's not always the case, but so long as that money is lent out and put to a productive effort, they actually do create money as a result of that leverage transaction. And this, to me, is the real productive value of banks and the financial system. So kind of wrap up part one right there. We're at, right at the 30-minute mark. That's really going to set the context for, I think, where we're going to take the next couple of shows. It's going to be different. I'm going to use kind of different definitions that I'm going to try and be clear about. And hopefully we're going to kind of learn some stuff here, and it's going to be interesting. So kind of go over to the chat 1 second. MA, again, thank you so much. So can banks help businesses get started? Absolutely. Absolutely. Banks, in fact, banks used to be more or less kind of the only people that got the only institutions, I'll say, that helped a business get started, right? You wanted to start a small business. Where does everyone turn first? You turn to your bank, right? The local community bank, and they would lend you money. You turn to friends and family. They would help a business get started too. But it's really that risk that sort of, now I don't want to say regular investing doesn't create money either, because it does in a sense very much too. But that what the bank was doing is that leverage the bank was taking, the money it was lending you, helped you create real value by starting a business in the economy, in a portfolio sense, right? You would go out and you would start a business, and your business would produce economic value just by definition of it surviving, right? And that, to me, is money, right? The money is a proxy for production, and if you have a productive business, that is money, right? Especially if you started that didn't exist, you created money with the help of your bank. Let's see. So, but the bank takes the risk, we hope, and has the knowledge to make good investments. Yes, that is true. That is exactly true. The bank is taking the risk, and that is part of the bank as a lender, right? The bank is a lender first. That is the bank's business, is to lend. And part of lending is to underwrite. And underwrite means assess the risk, assess the return, and make good investments. And the good banks survive. And, in a free market, the bad banks don't. And, that's probably a good way to end right here. Thank you, everyone. MA, thanks a lot for this, for all your support and your questions. Everyone else, if you're watching this on a recording of this, or you have questions afterwards, just kind of use that comment section. I try to answer comments, myself. Hopefully there'll be some good ones here, and we'll kind of move right along. Just bear with me. This is going to be a little bit of a slow moving topic, and I hope everyone likes it. So have a great weekend, everyone, and I'll see you next week.